Hello and welcome back to our inflation management tutorial. There's one question that's always coming up. How do we stop inflation? And when will it happen? Now, my opinion is not very optimistic and I will explain you why. However, I will show you at the end there's a clear path that is very promising. So let's look into this. Let's go back in history a little bit before to understand how inflation mechanics work. But before that, please subscribe to my channel so you get updated with the next videos that I will do on this topic, and you have a chance to suggest new topics for me to talk about. Okay, let's go into the history of inflation. My favorite topic is always the 1970s inflation period. And let's just go back to understand how inflation works, how can it be stopped, and how does it react to different factors. Now, as you recall, during the 1970s, we had three inflation shocks or three inflation peaks. We had the first one around 66 to 69. The Federal Reserve raised interest rates around 475 basis points to counter this inflation shock. So you see inflation went back. However, it came back again. And that was a very bad shock in 1973 to 1974. And you see the reaction, 780 basis points increase by the central banks. And I'm talking about the federal funds rate. So inflation came down during that period. But again, it came back. And that's a pattern that you have to keep in mind, and we will talk about it. We had a third peak, and that was a very famous peak, 1735 basis points federal funds rate increase. And then inflation came down, and then for the next years or decades, we didn't have that much of an inflation problem. Now, it's important to totally understand what happened. You might think it's just the interest rate rises or interest rate increases that fight inflation. You're wrong. I know everybody says that monetary policy has to get more tight, interest rates have to go up, and the problem is solved. It will not, and you will see it during the third inflation shock, what really happened and what needs to happen to fight inflation. And we will look into this. But there's a big problem. We are in a the central banks are in a typical central bank trap. We have record indebtedness in the US and around the world, and that makes it very difficult to raise interest rates. Keep in mind the numbers that I showed you before, hundreds of basis points increases. So several percentage points increases in interest rates. We cannot do that with the debt that we have. We will get a sharp economic downturn, and we might get that anyway because we see the first signs already. And then we come into this dilemma situation that on the one side, central banks want to raise interest rates because of inflation. On the other side, politicians and the general public will shout loud, "Don't do it, we have a recession." That's what I call the recesflation trap. It's not stagflation, I explained that in the last video. It's recession and high inflation occurring at the same time. And that's a toxic combination. And you need to be very skilled to address this. But I show you how you can do it. But before I do so, please understand the problem that we are facing with the record indebtedness. Just two numbers as a comparison. Government debt to GDP, 1973, before the second inflation shock back then, and in 2021. You see very quickly the difference. We didn't have that much of a debt problem in the 1970s. We have a debt problem now. And we have it not only for the governments, and not only in the US, we have it around the world. Let's look at this graph. It's debt to GDP over the last 50 years. Again, in the 70s, that ratio was around 100%. Now we are at 250 and above worldwide in terms of debt to GDP. Keep in mind, that means if you raise interest rates a little bit, it will have 2, 3 or 4 times as much of an impact on the economy. That's a very important point to keep in mind, and that prevents us from raising interest rates very quickly and very aggressively, because we will get into an economic problem with all that debt. People who took out the debt will not be able to serve on it, to pay the interest or to refinance it when refinancing is due. That's a very important point that, in my view, has not been discussed enough when you look at policy discussions. The consequence, what I assume is going to happen in the short to midterm, is what I call a perfect inflation storm. What does it mean? It's a severe and prolonged recession. We will see unemployment going up again as it did in the 70s. We will see debt defaults simply because rising interest rates and cooling economy is toxic for these high debt levels that we have. We will see financial markets coming under severe pressure. The stock market is already under severe pressure. We might see some liquidity accidents. That means when a market doesn't have enough liquidity to operate. So you might want to sell, but there is no buyer. And these are, when you are coming from banking, these are very, very tricky situations. And we will also see probably some erosion in terms of confidence in the financial system. We will also see some erosion, probably, that's my opinion, into the financial paper money system. There will be some people who say, well, maybe I go more into real assets, or some people might even think crypto. I'm not in that camp. But the paper money system, typically during times of high inflation and high uncertainty, gets a severe pressure situation. Investors therefore might flee from financial assets to real assets. You will also see, and I discussed it in my book, The Return of High Inflation. I think it's one of the later chapters in great detail, and I really want you to read this. It's very important. There are social and political tensions that will erupt during times of high inflation. And in some countries that might change a regime, a political regime, and end political stability and social stability. In my book, which I wrote in 2016 on this topic, The Return of High Inflation, I describe that, and I describe how Germany suffered after the big inflation period. So please do not ignore this. Your country might get into severe social and political disruptions. And obviously, if that happens, or when that happens, political polarization will increase and demagogues will take advantage of it. Unfortunately, that happens always in history. So that's kind of like a very bad outlook or a pessimistic outlook, but there is some hope. There's some hope if central banks and politicians learn from the history, in my view, and particularly from the 70s. So let's go one step back and then see what really happened back then. So I told you we had 3 peaks of inflation. So you might have asked already, why did we have the 3rd peak ending with a happy end and the first 2 peaks ending with a comeback of inflation? So why would we have that? Well, it's very simple. It was not just the interest rate shock that helped end inflation in the late 70s, early 80s. There was something completely different happening. And look at the green text that I wrote here. What happened in the early 80s was something that changed the ballgame for inflation. First, government teamed up with central bankers. I call it the President Reagan, Fed Chair Volcker dream team. It was a dream team to fight inflation. They were both on the same page. They were both committed. It was not the case like before that the politicians said, well, listen, I need to win the election and bring interest rates a little bit down, and we need a little bit more economic growth. No, they were on the same page. And then there was a pro-business, pro-productivity policy implemented. People call it the Reaganomics. You might have heard about this, but it had a lot to do with deregulation, lower taxes, pro-business policies, and market solutions were encouraged. I recommend to you, read some old history books about the late 70s and the early 80s. Today, you might not understand how outdated policies were back then and how little deregulation happened. And that was a major point, because think about this, when productivity goes up or deregulation decreases costs, these are advantages that you can give to customers or clients in form of lower prices. If your costs go down as a company, you can give that advantage, at least part of it, to your clients, and that brings cost levels down. There were also, and that's very important, real innovations. I highlight here real. It's not about social media that keeps us from being productive, all these social media services. What happened back then was a revolution. And I lived through that time, the early 80s, when all of a sudden we had WordPerfect, you know, like computer systems being developed that you didn't have to write anymore on your typewriter for a university paper. No, you could have a computer doing it. So that was the time the software package WordPerfect for writing texts and letters came out. Apple came out during that time with a big push in the PC market, personal computer market. And you might remember Lotus 123. That was the first spreadsheet program that I used during that time. And obviously all the calculations that we did before with the calculator and by hand, all of a sudden that went really, really easy. There was a software revolution, and that software revolution led to productivity gains. And that was a very big push to bring costs down, and these costs could be given, cost advantages could be given to consumers and clients and customers. Also, globalization kicked in. Global outsourcing. Some activities were taken from the US, or back then, I was living in Germany, were taken from Germany, given to other countries. And that was another way to bring costs down. So beating inflation back then was not just a big push in interest rates. It was a whole revolution that was going on in the economy, in politics, and in social life, and in the innovation area. And last point, demographics were pretty supportive of this situation too. We had the baby boomers time, and that also helped to change the climate that inflation would go down. So now let's transfer that to what should we do today. So if I was a consultant to the government, which I'm not, or central banks, I would assume the following. Again, this is my personal approach. I might change it over time if I learn more about it, but it's pretty much based on also my book, which I wrote already in 2016, warning about the inflation situation. The first one is you need a team approach between government and central bankers. You cannot go in there that the politicians say, well, central bankers, do your job and fight inflation, and the poor central bankers said, well, I'm trying already to raise the interest rates, but now the economy goes down. No, it has to be a coordinated approach, mutual respect, mutual support. Second point, and let's go back into science history. Exactly, I think it was the year 1944, famous science theory expert Karl Popper wrote about piecemeal social engineering. I highly recommend you this article that he wrote. It's in one of these books, Karl Popper Selections. there's a short article, and what he means is very important, and you can also use it in daily life or for your personal strategies. He said basically, and I summarize this very quickly, Karl Popper said, when you have a situation of fragility in the social world and uncertainty, go step by step. Don't claim that you know the outcome. Don't claim that you know what will happen, right? So let's go step by step. In this case, let's fight inflation step by step. Don't go crazy with the interest rates and then you blow up the whole system. Don't go crazy with some political changes. The typical thing, I mentioned that in previous videos, governments like to do price control. Price control has never worked in the history of inflation. And I looked at examples going way back to Emperor Diocletian. Back then already, it failed. It failed dramatically. So what we need is a piecemeal social engineering approach. Go step by step. Don't overstep your responsibilities and your impact that you might have and that you cannot anticipate at the current time. Third point, you need clear communication by central banks. It's very disturbing sometimes when in the morning on one of the business channels one central banker says A and in the afternoon somebody says A minus, the opposite, or another one later says, well, let's try B. That's confusing. We are in a very difficult situation where trust and confidence and predictability is very important. In these fragile situations, you cannot bounce the market or the economy back and forth with like, well, we might do 75 basis points, 50 basis point interest rate increases. Look back into the German central bank in the 70s. There's a reason why Germany has had much lower inflation rates than the US or the UK. There was a very clear communication strategy and predictability about what the Bundesbank, the German central bank back then, would do. You can admit that past mistakes happened. That's helping you to draw the line from the past. Don't try to forget that. It's open communication that wins. And again, a slow approach to financial tightening. We have record debt levels. We have never gone into an inflation period with so much debt in relative and absolute terms. At least in my analysis that I did for my book. And I looked at over 2,000 years of inflation history. So we need a cautious approach. We also need the non-monetary measures that will help. We have to acknowledge them, and maybe we can leverage some of these situations if it's possible for us. Now let's come to the government. The government, again, communicate that you're in support of a central bank policies, so to establish credibility. What you might do is lower taxes on items that went up sharply with inflation. I'm thinking about gasoline taxes. These are windfall profits for the governments. That's very easy to fix. You can have the same tax income if you just cap it at a certain rate. And I have never seen that on a wide scale used in history, but I personally think lowering the taxes on items that have an inflated base and that also helps the regular person on the street to manage inflation, that would be very good. You can also, quick win, reduce unnecessary tariffs, right? Now it's the time to get rid of them, bring the cost of goods to the customers down. Very important is you need to enable a productivity explosion. When you look at productivity figures, it shows very clearly we have a productivity problem, not only now, but already for years that we haven't addressed. We can reduce bureaucracy, we can speed up government processes, particularly the ones that lead to investments and anything that will increase supply to the customer, and that will help us with inflation. Another point I think is very important is refocusing the education system on technology, on science, on innovation, on critical real skills that will help us too, that will help filling the open positions that many companies cannot fill because they don't find the talent right now. That's something. It will take a little while, but let's not kid ourselves. Inflation will be around for a few years, so it's good to start this now, and it will also help later. We also need to do something which is a little bit tricky at the time, but we need to somehow kickstart a re-globalization initiative. If every country does its own thing and produces product A itself because it doesn't trust into global supply chains, this will be a very pro-inflationary approach. I can understand from a security point of view that some countries will do it for certain products, but in general we need to go back to globalization and hubs and economies of scale to bring costs down. The last thing what governments and central banks can do is pick targets for easy and fast cost decreases. Now, healthcare, for example, in the US could be an example. I never really understand why we spend in the US double the amount of money in relative terms to GDP than countries in Europe, and we have worse outcomes. I mean, this shouts for me like something, there are really big cost gains, cost reduction opportunities available. That's something to look into. We need to take a holistic inflation view. We might not succeed in bringing commodities down, the price for commodities, but for the customer or for the regular person, it is also very, very helpful if we manage to, at least if we have one category, let's say gasoline stays high, that we can bring healthcare costs down, so that in the balance we get a positive outcome for inflation and bringing inflation under control. Now, my outlook, as I said, is not optimistic. I'm interested in the real world, not in positive thinking or negative thinking. I'm just looking what's happening right now. I do think that central banks and politicians in many countries will make the same mistakes as they did during the 1970s inflation crisis. We will see more inflation, more pain due to policy mistakes. We have to anticipate that. Policy mistakes happen in every inflation cycle since Emperor Diocletian in the 3rd century, late 3rd century, who also did control measures to prohibit price increases and all this. It didn't happen. It was later Emperor Constantine in the early 4th century who brought inflation under control. But it was a prolonged period in the Roman history. And the same is happening today. It happened in the Middle Ages. When you look at this, don't do price controls, but at the end of the day, they will happen in some countries, and they will not work as they failed to work in the past. We might see some short periods of relief. So think about the 70s, that was like oscillating inflation numbers, and most of it is fake. It has to do with base effects. So if inflation goes up in one year, obviously the next year, because there's a whole higher base, so the next one might not go that high. So it looks like inflation is coming down, but if you don't see the measures that I described before, it's very likely that the relief is fake. Inflation will only end if you see these measures that I mentioned before: productivity initiatives, globalization, debt levels return to acceptable levels. That's actually a positive thing about inflation. Inflation is typically the only way, when you have record indebtedness, to get it under control again. As I said before, it might take some time. I wouldn't be surprised if inflation takes 5 to 10 years to bring under control. And but there's a chance if we do the measures earlier that I showed on the previous chart, and we learn from the Dream Team, President Reagan and Fed Chair Volcker, and transfer their approach to today. You cannot do everything one by one, but a lot of the philosophy behind it you can use. You might actually beat that rather pessimistic timeline. So this is my view about how to stop inflation and why I think it might take a while, and I'm having rather a little negative outlook. But please use the comments. Let's discuss, share our opinions. That's how science, also in social sciences, that's how we make progress. I will respond to every comment. Will take sometimes a little bit, but I will respond to you. Thank you very much, and good luck managing inflation.